Hi, folks. Chuck Gibson from Financial Perspectives in Pleasanton, California, with February 2016's charts on the move. On a shorter term view, you can see in my first chart of the S&P 500 index, we ended January with an oversold market. And I mentioned in last month's video, I expected we would see a powerful counter-trend rally, which could last weeks or maybe months. And that's exactly what happened, and where we end February with that rally still intact. From a longer term perspective though, it's all about the more things change, the more they stay the same, as the trend is still down. I need to clarify here that I'm speaking of the broader market indexes for the most part. There will always be pockets of strength and sectors that move counter to the broad market. My next chart is a weekly view of the S&P 500, shows we continue to be range bound between 1870 and 2150, and will likely stay there until the market finds the impetus to break out one way or the other. You can see this year and a half rounded top continues to be in play, and price remains below a downward sloping 200-day moving average. You combine that with the fact that we were making lower highs and lower lows, the weight of the evidence still suggests we're in a bear market, and a continued underweight of U.S. stocks is warranted. While I tend to use the S&P 500 as my vehicle of choice, I'm going to mix things up here and take a look at another vehicle, the NYSE. My next chart is that of the New York Stock Exchange Index, which is an aggregate of all shares traded on that exchange. In the upper pane is the McClellan oscillator, referred to as NYMO, and in the bottom pane is price. For those not familiar, the NYMO is a momentum oscillator which looks at the number of securities advancing versus those declining. Unlike most oscillators, this one ranges between plus 100 and minus 100. As a general rule, the more stocks that are advancing, the greater the momentum, the higher the NYMO reading, and a commensurate rise in the stock index. Oscillators' importance come not from their actual day-to-day readings, but rather when they exhibit extreme readings or when divergence occurs. When either or both of these conditions occur, they provide excellent warnings of short-term market reversal points. Take a look back here in the September-October timeframe of last year. You can see in the shaded area the index formed a lower low, while the indicator formed a higher low. This is a great example of bullish divergence, which marked a short-term bottom and the beginning of a powerful rally, rising 11%. Notice how the oscillator hit an overbought condition here and then began to fall, but price continued to rise. As you all know by now, this is bearish divergence and warned of a potential top and a reversal. And what happened next was a market drop of more than 15%. I want to move over to the rightmost shaded area now. Hopefully it's becoming more recognizable that patterns can and do repeat. As before, we formed a lower low in price here. The NYMO was diverging and forming a higher low. This warned an oversold rally was likely, and rally we did, bringing us up to date on this chart. Notice how, once again like in November, price is rising and the NYMO has reached an overbought condition, but we have yet to form divergence. Because divergence has not formed, and keep in mind it doesn't have to, it does leave the door open for the possibility of further upside. But the upside should be capped as we have a number of major resistance points above, the first of which is the declining 200-day moving average. Beyond that, it runs into massive overhead supply in this area. If the past pattern is any indication of what we might see ahead, once this rally is done, we would expect to see a move to new lows later this year. A good example of pockets of strength is my next chart of the U.S. consumer staples sector. This is one of the few stock investments still in our model portfolio. You can see prices above both the red rising 200-day moving average and the blue long-term support line. Also, RSI momentum in the upper pane is in the bullish range and above its midline. The one mark against it is prices hitting the upper channel of a rising wedge, which I've indicated with a black outline there. Rising wedges are typically bearish patterns and break to the downside. But while less frequent, they can occasionally be bullish. But until it makes its final decision on which way it's going to break out of this pattern, the current chart is bullish and continues to be one of our few remaining stock positions. Taking a look around the globe, my next chart is a comparative look at a few world leaders' stock markets. The top chart is the MSCI All Countries World Index, which is just an aggregate summary of stock markets around the world. You can see we breached the long-term blue uptrend line and have been moving lower by making lower highs and lower lows. The next chart is that of the German DAX. Another break of a long-term uptrend line and the continuance of lower highs and lower lows. Following Germany is China. I hope you're seeing a pattern here, because another break of a long-term uptrend line and the making of lower highs and lower lows. The US S&P 500 is next. It's the same story as all the above, with broken long-term support and lower highs and lower lows. Finally, the last chart is Japan. And I hate to keep repeating myself, but virtually all stock markets are in the same condition. Hopefully you can see from the charts the frustration and struggles we have as investment advisors right now, because if your goal is to invest in only things that are rising, the choices are becoming fewer and far between. Unless you're a trader and nimble enough to play the short-term counter-trend bounces, or willing and able to capitalize on a downward trend via short positions, until things change, stocks are an area to avoid, and cash is king. If you're a returning listener, you should know by now I use longer-term charts to determine direction and shorter-term to zero in on an entry or exit points. I prefer to use weekly charts instead of monthly for direction, not because they work better, but rather because you must wait an entire month to see if you get a change in your signals, and that time delay over the more responsive weekly charts can have a big impact on returns. Another thing you'll likely recognize if you follow my posts is that I'm a pattern guy. After years of chart analysis, it's clear to me patterns repeat. Being able to recognize them and the confirming conditions needed, if used correctly, can provide a substantial long-term return advantage. With that in mind, I want to present my last chart, which is a 20-year monthly look at the S&P 500. In the upper pane is PPO, which is a price momentum oscillator, and the S&P 500 price is in the second pane below. Once the faster blue moving average of the PPO crosses under the slower red average, this indicator signals a top is in place and we are starting a new bear market. I have marked with red circles where that cross has occurred in the past, and you can see it's done a really good job, if you took the signal, of sidestepping major losses. I want to point out that the cross occurred early last year for its most recent signal. Moving to the price pane, the blue rising wedge pattern should jump out at you. You can see what occurred after a break of the wedge in the first two occurrences. Look at the present. We broke the wedge mid last year and are poised for a move lower. As bearish as the charts that I presented are, I do want to temper it by saying that no one knows what's going to happen next, including the charts. The market has a way of confusing and frustrating as many investors as it can. Anything is possible, including a move to all-time new highs. But using a weight of the evidence approach, I must respect the current bearish signals, but I'm on the lookout for an indication the market may be changing course. Well, that's it for this month. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with February's Charts on the Move.